Hi, I'm Wade Johnson, partner of Cutcher Neale Wealth Management, and I'm joined today by Justin Beeforth, advisor and investment committee member, for an update on the markets in August. Global equity markets slipped 4% for the month of August, losing moderate gains made in the first 3 weeks of the month after a hawkish speech from US Federal Reserve Chairman Jerome Powell on the 26th at the annual Jackson Hole retreat. The Fed chairman was very direct about the problem that the United States is currently facing. The labour market is too tight and inflation is too far above the central bank's 2% target. To address this, he noted that the central bank intends to push interest rates higher and keep them there for longer than markets have been expecting, an unconditional policy that will inflict pain on households and businesses. Global bond markets followed the lead of equities, with US 10-year Treasury yields increasing from 2.75 to 3.19%, and European yields increasing from 0.77 to 1.54%, both representing substantial slips in the price of bonds. From a commodities perspective, we saw broad-based reductions in key economic costs such as shipping, agriculture, metals and oil. The major pain point here remains the price of gas in Europe and the UK, with sharp volatility continuing to play out on the back of each headline. As the war rolls on, winter approaches and the price control conversation develops. Highlighting these energy pressures were the Bank of England's comments that they expect UK inflation to hit a remarkable 13% in the final quarter of the year, due to a near doubling in wholesale gas prices, with inflation to remain at elevated levels throughout much of 2023 before falling to the 2% target in 24 months' time. Justin, how were domestic markets during the month?
Thanks, Wade. Back at home, the first week of August saw the RBA move the interest rate upwards by 50 basis points to a total of 1.85%. In the face of an interest rate rise and the various global pressures described, the Australian stock market stayed resilient over the month, sliding fractionally. The banks, traditionally net winners in a rising interest rate environment, held steady with small gains from Westpac and ANZ and a moderate decline in the Commonwealth Bank. Mining stocks saw weakness on the back of softening iron ore prices as record-setting heat waves drove energy rationing in Chinese production, alongside production pressures from decarbonisation initiatives. On the other hand, lithium was a standout as the full financial year reporting season began to confirm the record profits that miners are now making in the space. Consumer staples full year reporting confirmed the ability to pass on inflationary pressures swiftly and at a profit. However, management commentary for the period ahead addressed a discernible shift in customer shopping behaviour. Highlights include a move towards more conscious choices, shopping to budgets resulting in fewer basket items, as well as trading down from fresh to frozen vegetables and from red meat to alternative protein sources such as pork and chicken, which the staples sector will address with a focus on operating costs and maintaining consistent margins. From a bond perspective, the yield on 10-year treasuries increased from 2.98% to 3.68%, in line with global movements. Finally, the US dollar and the euro rallied against the Australian dollar, with the Australian dollar strengthening against the British pound and the Japanese yen. The median forecast from Australian banks is for the Australian dollar to reach 72.4 US cents by mid-2023 and 74.7 cents by the end of 2023.
Thanks, Justin. Please call your wealth management advisor if you have any questions, and we'll see you in October for another update.